Welcome back to the Scholar Wealth Podcast, where we answer questions from high net worth families about building, protecting, and transferring wealth. Today, we're taking on two big topics that come up often where clients start thinking about their financial future, taxes and retirement. So let's jump in with question one.
You mentioned tax planning as part of your process. What's the difference between tax planning and tax advice, and when should I be working directly with a CPA instead of a financial advisor?
We find that tax planning is more forward-looking, where tax filing or tax advice is generally backwards-looking. So to explain that a little bit, what I mean is that when we do tax planning, we're looking at projections out to the future to say, what types of assets should you sell? Should you do Roth conversions? What tax bracket are you likely to be in the future? And then what can we do today from an investment side to minimize those future taxes? That may be something like you should hold off on selling a concentrated position for a year, or you should wait until your income drops before a Roth conversion happens, or maybe we delay Social Security so that way you have more lower income years for a Roth conversion. Those types of things are more on the tax planning side. So we're not looking at today's income and filing it or paying taxes, but we're looking out the future and saying, are there decisions now that may be able to reduce taxes this year, but that may reduce taxes 5, 10, 20 years in the future? And sometimes it's not as much even reduction in taxes as much as it is hedging against an increase in taxes. So looking at things of saying there's a risk that this type of tax increases in the future because it's always the target of tax law. So what can we do today to lock in tax rates today so that future tax planning is a little bit easier? And sometimes the fun of that is also going into multiple generations of it. If it might not be what you'll pay in taxes, but what your kids would pay or what your estate would pay in taxes in the future and how that affects decisions. When you start bringing in a CPA, generally the CPA is going to handle the technical filings or any compliance issues that tend to go on. They can also do that short-term modeling of let's project what next year's tax rates are going to be so you know how much to pay in quarterly taxes. So if you think about it from a software perspective, we're running models on your entire portfolio investments, what's coming in from dividends, what's coming in from interest, where your CPA is going to be looking at what does your tax return next year look like, and what deductions look like, what credits you're going to be eligible for. So that tends to include a little bit more gray area. And what I always like to say is tax planning is the black and white. If we know a tax law exists, we can give advice on whether you should sell something or whether or not it's long-term gains for short-term gains and what that projection looks like in the forward. The CPA's role is going to be the actual filing of documents and handling any of that gray area. Can I deduct this? Can I not deduct this? It's a questionable thing. That's a decision that your CPA would be able to make with you. So when we start to involve a CPA in the planning side is when we start looking at big events, IPOs, business sales, inheritance, when you start looking at things like a big Roth conversion, any complex income, whether it's K1 income, multiple states, anytime when that coordination would help prevent surprises. And that's really where tax planning works really well as a partnership. And what you'll find is that you tend to surround yourself with a team. In other words, you have a financial advisor who tends to be quarterbacking a lot of these different relationships. And you may have an estate attorney that's dealing with your estate work, and you have a CPA that's doing your tax filings. You might have another attorney that deals with your business or with real estate interests that you have. So it takes a team and a partnership to really get through all of the different planning that needs to happen on the financial advising side. And now we can go into our next question.
What does it actually mean to prepare for retirement? If I am 3 years out from my target date, what are the focuses of financial planning?
When you hit that 5 years pre-retirement, I'd say 5 years pre to 5 years post-retirement is one of the most critical time periods throughout your financial planning life, because we're looking at things like a reduction in income. You're going to cut that off. And a lot of people don't take that into account as much as it needs to be, in that when that income drops, the odds of you being able to ramp that income back up after you leave your job is very difficult. So we want to take that seriously of how to plan for retirement, make sure that all the boxes are checked. We need all the I's dotted, all the T's crossed, everything really looking good. So when you're talking about what does that mean to plan for retirement, it really takes its form in a lot of different ways. We're looking at liquidity needs, how much cash you should keep on hand. Should you be building up that cash now? how many years of cash, what your spending is going to look like. What typically happens is people retire and their spending jumps because you take all those fun trips you've been planning for, you go do all the renovations to the house, you do all these fun projects, you take on some new hobbies, you're testing things out. So income tends to spike during that time. But we need to plan for that. We need to plan for the fact that income is not likely to be flat throughout retirement. Typically, you have your go-go years of retirement, your go-slow years, and then your no-go years for retirement when it comes to travel. So we need to plan accordingly. We need to look at things like what your tax rate's going to be in retirement. Are there opportunities there when your income drops? Should we get rid of should we take on some capital gains at a low tax bracket? Should we do some Roth conversions to take advantage of those drops? And what about actual liabilities in your life? In other words, should you have your mortgage paid off? Generally, that answer is yes, but there's some exceptions there, especially when it comes to interest rates and what your whole portfolio looks like. We want to know how you plan to manage cash flow in retirement. Do you plan to take a monthly paycheck from your portfolio? Are you going to have some pension money? Are you going to have Social Security? Are we going to be selling bonds first in front of equities? All of that is not something you want to be dealing with the day one of retirement. You don't want to have the retirement party and then the next day you have no idea where your money comes from and what's the most tax efficient way to get it out. So when we start thinking about retirement planning, we start thinking years ahead of it's time to soften up the portfolio. It's time to start building up maybe a bigger bond position going into retirement, because the year you retire is going to be the most risky portion time for your entire portfolio. What I mean by that is, from the sequence of return risk, what we want to try to avoid is you retire, portfolio drops the next day, and now you're pulling, as we just said, the most amount of money ever from your portfolio at a time where your portfolio is the lowest, which is not a good combination. So we want to mitigate those risks. We mitigate those risks through liquidity. We mitigate those risks through different asset allocation. That maybe we build a bond tent, so to speak. We build up your bond allocation to retirement. And then after retirement, we can actually start dropping that bond allocation back down. So we're looking at things like stress testing. We're running Monte Carlo simulations. We're stress testing against different market events. We're stress testing against different liquidity events that come up. Maybe you want to give a big gift or you want to buy a vacation home. Can you handle those types of scenarios? Can you handle long-term care expenses later on? So all of that needs to be taken into account in a holistic way, because we can't look at liquidity without looking at major financial goals. And we can't look at those major financial goals without looking at the asset allocation. So those last 5 years are really all about preparation, precision, really trying to break your plan. I joke that a lot of our role is trying to make a financial plan not work just as much as it does work. We want to build a plan and say, this one looks good. The reason why we think it looks good is because we've thrown the kitchen sink at it. We've looked at it of, what if inflation jumps up to 3 or 4% indefinitely? And we combine that with a 30% drop in the market the year you retire. We combine that with some long-term care expenses later. And you have all of these different combinations. It can't survive all of this. And if it can't, what are the levers that we have to pull? So that way, going into retirement that, you know what, even if this stuff happens, that just may mean I have to cut my travel budget back. Or it's not going to be a factor because I have 2 years of cash that I can pull from during that time. That would help to reduce the risk of those types of scenarios. It's a big event in people's life, probably one of the biggest financial events that someone has. So we want to make sure it's taken care of it. We're handling all these different areas in a holistic way so that you're going in with a roadmap into retirement, so you know where you're going and how you're going to get there. And that's our show. Thanks for listening, and we'll see you next week. Hey, this is Stephan Shipe. Thanks for tuning in to the Scholar Wealth Podcast. If you have a question you'd like us to tackle on a future episode, share with us at scholaradvising.com/podcast. We'd love to hear from you. Until next time.
The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests, and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.